Okay, well, it's a pleasure to be here, and I'm very thankful for the invitation to come and present this paper. It's very unique to actually have a conference on policy uncertainty. It's very exciting. We had a prior paper looking at policy uncertainty, and in finance conferences we always got placed in very odd sessions, and it was difficult to place the paper within that session. Now the complication is most of our motivation and underlying theory has been done, and really I could present our results in about 5 minutes. But I want to go through and spend a bit more time on the identification strategy we use in this paper, because I know from talking to some of you yesterday you're thinking about using this, and there's certainly some shortcomings to doing so. There's some challenges that I want to talk about, and some of the limitations on our conclusions. This paper is joint with Young-Suk Yuk, who is here from Sungkyunkwan University and are currently at the University of Maryland. So as we all know, we know all this stuff. There's a thankfully rapidly growing literature looking at both the real and financial effects of policy uncertainty, political uncertainty. And one of the big questions, of course, is whether it's really policy uncertainty causing changes in the real variables that we're interested in. And of course, the big debate right now is whether the current sluggish economic environment is due to a lot of economic policy uncertainty. And unfortunately, a lot of this debate has become very political. So we want to take a step back and just say, is there some causal evidence out there that policy uncertainty actually does have some real effects? And we're going to do it in an international context, looking at cross-border flows of capital. And I'll explain why as I go along. Kind of a telling thing I've noticed in this conference is, despite having a lot of similar papers, nobody has yet used the same quote, motivational quote. So I brought 4 here. The most recent, in October, the IMF announced or said that it appears there's some veil of uncertainty that's restraining growth. So I'll go through the theory fairly quickly because I think we've discussed most of these papers, Kucherman and Bernanke being some of the classic ones. And this is the way we're viewing our empirical environment. This is a purely empirical paper, so you might want to shift your brain to thinking very empirical after this morning's papers. So in these classic models, what's really going on, and there are various mechanisms through which uncertainty can translate into real effects. In these models, it's typically some irreversibility in conjunction with some possibility of bad news, where this bad news principle that Kyle mentioned in his presentation is fairly broadly defined, right? It could be the probability of something really bad happening, or it could be more subtle, like what Jonathan mentioned in his example, that you have a bunch of different projects and maybe the possible outcome is just going to reorder the profitability of your projects, and that still gives you the incentive to just be a little cautious and wait to invest until the uncertainty is resolved. The model that motivates this particular paper, because we're going to look primarily at foreign direct investment around the world, is the Roderick 1991 paper, which is really about uncertainty and foreign direct investment. And there the mechanism's basically the same. You have a domestic investor who's thinking of investing abroad. So they can invest abroad or keep the money domestically. And the key parameter there is the probability of a probability reversal in that destination country. So if that probability is high, you're going to wait until you learn more about that probability. And in their model, they find that it's extremely sensitive to this probability of policy reversal. That is, suppose you just increase the probability of a policy reversal by 10%, that would require a 7.5% subsidy to keep investment levels the same. So in his model, uncertainty acts just like a tax on investment. Now, he notes in his paper, his final section talks about kind of the impossibility of really testing this type of thing for the reasons we've discussed, and that is measuring policy uncertainty is very difficult. There are problems with interpretation of certain proxies for uncertainty, and of course there's the endogeneity and reverse causality issues that we've also discussed. Okay. Other mechanisms noted, Pastor and Veronese have the risk premia channel. You've got Recently, Panucci and Papanicolaou have a paper where managerial risk aversion can also induce an agent to be cautious in the face of uncertainty. Just a picture I made before we came. FDI flows, this is from United Nations data. So what I'm plotting here are the total outflows and inflows from and to the United States of foreign direct investment. And you can see that foreign direct investment has been one of the casualties of the recent crisis. And recently it has started to pick up again. But it dropped by between 40 and 50% after the financial crisis started. Now, we're not going to address the current crisis. Some other people here have done so. So we want to get kind of away from that argument. We're not big enough to jump into this debate. So we want to step back and just say, is there really a relationship between policy uncertainty and real economic decisions? Now, why are we going to look at FDI? Well, it's the same reason that Roderick did back in 1991. There are a lot of reasons why FDI should be very sensitive to policy. And I'll show a few more papers, both theoretically and just basically by definition. FDI is very costly to reverse. It's relationship specific, and it's typically a very large investment. So just take the definition from the IMF Balance of Payments Manual. So it's, of course, one resident investing in another country is a lasting interest. The lasting interest implies the existence of a long-term relationship between the direct investor and the enterprise, and a significant degree of influence of the management over the foreign enterprise. So the statistical definition of foreign direct investment, and this is what distinguishes it from foreign portfolio flows in general, is it requires at least a 10% equity stake or control stake in that foreign entity. Okay? And so the FDI measures that we use, we're going to use a couple, are going to capture these equity funds provided to foreign affiliates either through equity contributions, intracompany loans, and reinvested earnings. Okay? And this is foreign portfolio flows, by definition, are going to be equity. We also have debt flows as well that are below that 10% threshold.
Brendan, are you excluding them in part because they're just transactions of publicly traded equity that there's no irreversibility clause, for example?
We're going to include them for that reason. So what we're going to do with the identification is we're going to take the timing of elections that Art described yesterday, and we're going to look at how they affect FDI flows versus portfolio flows. Yeah, that's right. That's right. Okay, so just there's a large FDI literature, and we're probably going to try to place this paper within the FDI literature. So we're going to follow a lot of what they do. So you've probably seen some of these papers. So FDI is hypothesized to be very sensitive to the political and institutional environment for various reasons. And there are theory papers that suggest that FDI is actually a solution to some of these international frictions or informational frictions, such as Rosen-Sadka-Nguyen, Goldstein-Raisin. Dixit recently has been doing a lot of work on institutions and foreign direct investment, and he makes the argument that foreign direct investments are very sensitive to the political environment because of irreversibility, but also because you just have a foreign person investing in another country who might not get the same treatment by the judicial system. And in the absence of some supranational judiciary, it's hard to protect the property rights of foreign direct investors. A classic paper is Caballero and Hamor, who look at the relationship-based characteristics of FDI. And in their paper, this relationship reduces the flexibility of decisions. And foreign portfolio flows, as I mentioned before, it's probably quite obvious, but it's also been modeled that they're more flexible, basically. All right, so that's why we're going to use FDI and FPI. So now let me talk a little bit about the identification strategy and why we're doing this. So there have been some early attempts to try to identify political effects more broadly defined than what we're talking about. They're often looking at political instability. So Barrow, Alesina, Perotti, and Morrow They look around the world and basically correlate investment rates with various measures of political stability, labor strikes and so forth. And they're very open with the fact that it could be what's happening is the deteriorating economic conditions cause instability. We've got the very well-cited Baker-Bloom-Davis paper, which certainly appears to be picking up something, but there's still a slight endogeneity concern. I remember reading a blog post when the paper was quite new. You might remember this, where Rupert Murdoch was hypothesized to be the underlying source of this. Right, so I think that he's since changed his mind, but it's just very interesting claims. And Roderick, in his paper, like I mentioned, he kind of
listening in on our telephone calls, I think was.
Oh yeah. And Roderick pointed out, he uses just a few anecdotes at the end of his paper to suggest that there is evidence consistent with this, but he basically says it's going to be very, quite difficult to try to identify this. So our approach is to use the timing of national elections around the world. This is similar to what Art Durnev did yesterday. We have another paper we've done this, and there seems to be a flurry of papers coming up using this identification strategy. So I want to talk, so this will be a little bit different. I'm not going to dogmatically defend our results. I want to be quite open with this identification strategy, given that we all kind of have the same views on the real effects of policy uncertainty. So the nice thing about using elections is it's quite intuitive, right? If you're thinking about an event where the probability of policy reversals is going to be relatively high, it seems fairly clear that around election time, there's a higher probability than normal because of possible turnover in government. Of course, the real question is it really, and you'll see there's going to be a fairly large effect, that FDI flows drop off in the pre-election period and then come up a little bit afterwards. The big question is whether that's really uncertainty that's driving this drop. Okay, and so I'll talk about some theories that might explain it, and we'll try to exclude those particular theories. But like any other natural experiment type of a framework, really all we can do is kind of narrow that chasm that you have to jump over to accept that causality has been established. So we're certainly not ending the literature here. So please do continue with your efforts.
So, Brenda, we've always had this discussion. You've thought about this more than us, which is there are two reasons why elections could increase uncertainty. One is discounting. So we think in the US at the beginning of just after a presidential election and 4 years off the next one, therefore the uncertainty is just discounted 4 years out. And then the other model is more on salience, and I just don't think about it and I ignore it altogether, and then as I come up to the election I suddenly become aware of it and then take it more into account.
Yeah.
And if the discounting always struck me as quite weak. I mean, if you think of FDI, for the types of things you're looking at, it's typically quite a long run decision. It's not zero, but pushing things 4 years out is going to have some effect. My sense is you'd want anything big, you'd want to also require some kind of salient story there. Because I mean, we see it in our news index, it spikes coming out to the election and falls back down again, which to me seems very much like a salience issue in the news, because newspapers talk about it. But have you had any thoughts on which of those two effects or other?
Yeah, we kind of ignore the whole discounting thing. So in the motivation, we talk about the salience. Sorry, Stephen?
I mean, another one is the timing of election is tied up obviously with who's going to be the political leadership, but also you get clues early on as to what they're going to do. So in the U.S., you see who the president's going to appoint to the cabinet and so on. So there may be a lot more going on than just the discounting effect you're describing.
Yeah.
You're learning something in the run-up to the election with what the candidates say, and then what the victor does in the near-term aftermath of the candidate is clues about the direction of policy over not just over the next 4 years or whatever it might be. So that's more than discounting, and it's not just about salience.
I guess the question is on 1 year before versus 2 years before. 1 year before an election versus 2 years.
Yeah, Okay, well then,
Yeah.
then you're isolating something that's more like a
Because
discount.
discounting there's a pretty weak thing, and I presume it's 6 months out. I mean, we still haven't learned. I agree the day after the election a lot, and 6 months after the election,
Yeah.
we've learned a lot. Somehow, I mean, we see in our index it spikes up and down, and Art used.
Yeah, and our results are similar to that in that it's really concentrated in the time right before the election. There's a little bit of drift downwards, maybe 6 months out, but then it really drops in the period right before, and then starts to rise gently immediately after. And we try to get at the salience a little bit because in our identification strategy, rather than just look at elections, we're also going to look at a lot of variation in what we think picks up salience. That is, some countries or some elections are more important than others. Or in some elections, there's a higher probability that the whole government's going to change or that major policies are going to change. And sometimes it might be very much irrelevant. If you have 15 veto players in the government, then electing a new national leader probably isn't going to be very salient. But if there are only 2, that's probably going to be much more important.
Yeah, I agree with Steve that there could be more than discounting to this, because in the 1 year before the election, you get a lot of signals about what these potential future leaders are going to do. There's campaigning going on, a lot of speeches. Nothing like that is going on 2 years before the election, or even 18 months before the election. I just think it's a different environment. In which
Wouldn't that reduce uncertainty though?
many more signals are coming in.
Wouldn't that
Depends on what
reduce
they say.
uncertainty?
Depends on what they say.
But on average, I mean, because you're looking at the average across all elections. The average of average across elections, you'd think information, you get more and more information running up to it.
Yeah, but
It's uncertainty.
the candidates have strategic motives to differentiate themselves from each other that get sharper as they get closer to the election.
But under
So
rational expectations, you'd expect, I mean, I agree, but you'd expect, it's somehow under the average of average, you have rational expectations, you know on average what's going to happen running up to the election. If anything, you get more information running up to it. So maybe we come back to empirics, but
Yeah, you
it's
get more
maybe why the,
information, for sure, but you don't necessarily get information that tells you that the potential range of outcomes is shrinking.
it's why I
You
think
don't
potentially
see.
having another index along news, I mean, news is going to very much play off the salience
Yeah,
angle.
yeah.
Whereas in fact, if we had some other, like, you imagine you had InTrade, would be perfect to compare them, because InTrade is, or
Right.
something else is going to just
Right.
care about the truth and not the
Well,
salience.
the beige book stuff gets into
Yeah.
it a little bit.
Yes.
Yeah, with I think your stuff would be it'd be very interesting to take, like, maybe instrument using elections in connection with the information you have from the news media. With us, we're just going to have these spikes, and you'll see that it drops right before. So we can't really get too much, unless we look a little more deeper into what's going on around the election. But, even now, right, we're trying to forecast who the next set of candidates are going to be, like Hillary Clinton versus Paul Ryan, for example, right? But it won't be for a while till we really know. Okay, so we're going to call this a semi-natural experiment. I have to be careful with phrases. Some of them have very precise statistical meaning. By semi-natural, we mean, well, certainly the elections, the timing of elections are out of the control of any individual firm or foreign direct investor. However, around the world, as Art mentioned, some countries have an option to call an election early, whereas some countries the election is fixed in time by electoral law or tradition. So we're going to be able to, of course, separate out the countries and to see what's going on. So at least we can rule out the reverse causality, that is that the drop in FDI flows is not causing the elections to happen. Okay, so of course we need to talk about what the identification strategy requires. I think the easier part, or the most intuitive part, is the first one, that is the timing of national elections corresponds with fluctuations in the degree of policy uncertainty. All right. And there is some evidence from financial markets, at least consistent with this view. So Art's not here. Art has some work where he shows that stock market volatility is abnormally high during elections around the world. There have also been people in political science looking at changes in exchange rate volatility, bond yields, and so forth. And of course, the Baker-Bloom-Davis index spikes during the election time. Now, the difficult part is the second kind of exclusion restriction type of idea. We would like to be able to assign uncertainty to what our results are showing. We want the timing of national elections to be uncorrelated with the other factors that determine foreign direct investment, except through the uncertainty channel. And probably the two most obvious, there are others, these are the ones that have been covered in the literature at least. The study of elections empirically used to be quite in vogue from the 70s to the early 90s. And that is the endogenous election timing. So Ito has a paper where he shows evidence that in Japan, the government tends to time elections strategically. Whereas Alesina, Cohen, and Rabini do a cross-country study, and they don't find evidence of endogenous, or at least strategic timing. But nevertheless, we can separate out fixed versus endogenous timing of elections to show that this isn't driving what we find. Probably the most difficult one to deal with is this literature on political business cycles. Okay, very broadly defined. And that is, starting with Nordhaus back in 1975, so if you're an incumbent politician and you're coming up for election, and you know that, and this appears to be true, that voters to a large extent base their decisions based on recent economic performance, and you have some of these levers at your disposal, you might try to pull a few of them right before the election to maximize the probability of being elected. Okay, now this theory model has been challenged, with rational expectations and stuff like that. And just as a funny aside, when I took my taxi ride to Paddington to come here, the driver was from Nigeria, and hearing my American accent, he asked me how much I loved Obama. And he had this idea that the Republicans were somehow going to fix the election like they did in 2004. And he told me in Nigeria, what happens is around election time, they leave the lights on longer to try to bring votes in provincial elections. And I asked him if it worked. He said, no, I don't think so. We all know what's going on. And that's the Alesina critique of the political business cycles. But it still doesn't rule out that they may try to do things. So empirically, there's not a lot of support. And this literature kind of died a few years ago. We're going to repeat these tests to see if there's anything going on with our sample, at least for those mechanisms that have been hypothesized the politicians might use. So Alesina, Cohen, and Rabini and Drees in 2000, they say at least for OECD countries, which is where they have most of the data, it doesn't look like that incumbents or at least pulling the traditional levers that we thought they might be using. So we use the Alesina et al. Methodology, which is basically just some time series or panel regressions where we look at changes in government spending, changes in money supply, changes in interest rates, and changes in inflation around the election cycle to see if they're any different. So they have an election indicator that takes a value of 1 in the pre-election period. And our results are very similar to what they find. That is, the government choice variables, at least most of our sample, the central bank is relatively independent. It's not clear that they'd be able to change the money supply or interest rates fairly easily. But at least in either our full sample or exogenous timing of election sample, we don't see this going on. Now this is where we have to, Steve, were you?
You further restrict the sample to be close elections ex post. So exogenous timing in close elections, because that seems like when the incentive to try to manipulate the policy levers is strongest. And
yeah, that's something we can do.
You might find something in that.
Yeah, you're right. We will absolutely try that. The one concern we have, and this is of course the thing that I think the final assumption you have to make when you're using this identification strategy, is there aren't some kind of unobserved things going on, like leaving the lights on longer. Or maybe the incumbent raises the minimum wage prior to the election that we wouldn't pick up in these tests, kissing a lot of babies, I don't know. There is some evidence that, or at least there's an argument that one of the reasons why Medicare was expanded when it was to help George Bush's re-election hopes, and that's of course impossible to test. But those are unobservable things that could contaminate our inferences here.
Just wondering what your sample is here, because I thought there's some more recent work by Alan Drazen that finds that actually for new democracies, you do find these political cycles with recent consumption.
Yeah, Paul Voller has some work on this as well, looking at like changes in sovereign debt spreads for emerging economies. Yeah, absolutely. In our sample, we don't find anything, but it could possibly be going on. Yeah. Okay. So let me just summarize the result. Oh, one more, I guess, disclaimer before we go on, and this point was made yesterday as well, is that our idea of policy uncertainty, given our identification strategy, is kind of necessarily broad, right? So there are a lot of uncertainties around an election. I guess we should probably call it electoral uncertainty, right? There's the uncertainty about who's going to be in power. There's the uncertainty about what they're going to do when in power. There's the uncertainty about the efficacy of said policy changes once in power. And of course, there's uncertainty about what the overall composition of government is going to look like after the election. All right, so when we're talking about policy uncertainty, we're thinking in very broad terms.
So you'd be fine, for example, if the two candidates were more or less identical, or Coke and Pepsi or something. But it could be just important that they're going to do something new after the election, and that's...
Yeah, and we had at some point tried to look at the difference between the two candidates. So the World Bank database of political institutions has fairly good explanations of the political platforms of all the various parties in the countries running for election. And so at some point we were trying to classify them quite broadly as maybe market-friendly versus market-friendly. And when we shied away from that, the political aspect of it, we were afraid. But it's something that could be feasible if we came up with a decent
The
classification.
point of view that that's all rhetoric, that these guys are the same, exactly the same. They talk different.
Yeah.
But there still could be an electoral pattern, and after you're elected might be the right time to roll out your policy that your opponent was going to roll out as well. But
Yeah. Obama Romney this year, right? The foreign policy debate sounded pretty identical, and yeah. Okay.
I want to just make it. I think it's a slightly different way. There may be no ex ante difference between the two candidates, at least as far as you can perceive. But first years of new terms of prime ministers or presidents are more likely to be periods in which some major policy change is initiated, and that's something that you could try to get some direct evidence on. And I guess I wonder, it's not immediately obvious to me how to do it, but you'd like to know, is there some systematic pattern that in the aftermath of national elections or changes in the political leadership, you see a larger likelihood of big policy changes,
Yeah.
right?
Yeah.
So one other kind of unobservable, I'm thinking of this kind of, especially in relation to like the United States, is that during this lead up to the election, there's a lot of other things going on in terms of like a much more crowded media market.
Yeah.
And perhaps like people's attention is less focused on new products and more focused on an election, especially, and this kind of corresponds to this may be more so in less stable governments or closer elections.
Yeah.
So if I'm wondering if I'm not as familiar with this data, I don't know if there's any way to break down whether it's like a new entrant or an expansion of existing FDI. Like if I'm trying to bring a retail store into a new market, I may not want to enter at a time where there's this huge amount of kind of other media exposure of a big national event going on, and I may want to wait just because, not just because of uncertainty, but because after the election, I can buy ads or get people's attention more easily.
Yeah.
If you could look at like the first store that somebody opens in a new country versus the second store, maybe you don't have to have that same.
Yeah, so two comments on that. I think you're right. The attention one seems very salient to me, right? Because probably all of us this year were repeatedly watching Rick Perry trying to name the 3 agencies he was going to cut, right? Which took us away from our work and then showing our colleagues how funny it was. So that's one of the possible unobservables that we cannot rule out, and I don't know that there's been research on that. In terms of getting it, I think that's a good point, looking on initial investment versus maybe just additional follow-ons. With the FDI data, it's aggregated. But one way I guess we could potentially get at that, because a lot of FDI is really cross-border M&A, greenfield investment, project finance type of stuff, is perhaps to look at cross-border M&A separately where there's an initial deal and see if those are very sensitive to the election cycle. That's a possibility, I suppose. And we will look within country. So if the U.S. has some tradition of just wasting a lot of time waiting for the election to happen, at least culturally we can net that out, but then you've got the problem that maybe the really close elections are going to be driving the inattention. All right? So this is refreshingly open. It's nice to be in a crowd like this. Okay, so just to summarize our results, so we look at 43 countries around the world, and what we find is that in the quarter just before the election, FDI rates, so this is the FDI flow in that quarter divided by the previous FDI stock in that country, drops between 14 and 21% relative to non-election quarters. So it's a fairly large effect. Now, FDI data are notoriously noisy. So Yi's advisor warned me about this, that both portfolio flows and FDI data are very noisy, and not to be overwhelmed by the size of the test statistics you get. So it's a fairly wide range. But I will note that it's larger than our earlier paper where we looked at just domestic investment, which is consistent with the view that foreign investment is going to be more sensitive to political factors than domestic investment. And then basically the second part of our identification strategy is to slice up the sample a little bit. And what we find is that this change in FDI flows around the election cycle are larger when the elections are close. Here we just use an ex post measure based on the voting returns. In less stable governments, in governments where there's either more debt to GDP or higher government spending to GDP, suggesting that policy is more important in those types of countries. And we also look at an interesting measure of the degree of checks and balances in a particular country. And this is time varying, which is quite nice. And I'll describe that when I get to the table. Okay, the FDI data, if you're interested, there are two primary sources, so we're using both. The one we're going to use in the test I'm going to show you is from the Bureau of Economic Analysis. We like this one because it's on a quarterly basis, so we can get a little bit closer to the timing of the election. A lot of the papers that use elections as an identifying strategy use annual data, so it's a bit harder to get the effect. So we have quarterly outflows to 43 countries. The foreign portfolio data is going to match the sample period. So this is just the net purchases of long-term foreign securities, both debt and equities, by U.S. residents. So we get these from Bertone and Tryon. The other source of UN data, FDI data, is from the United Nations. And this is a broader sample in that the quarterly data I'm going to show you is exclusively flows from the United States to 43 different destination countries. So it's very difficult to identify the effect of US elections because basically we're just going to be measuring the average of some calendar time effects. With the UN data you can get at it because for as many of the countries as it follows, it calculates the total outflows and inflows from any country J to any other country K. So we have the outflows from United Kingdom to the rest of the world and from the rest of the world to the United Kingdom. And it's a little easier to identify domestic policy uncertainty at the cost of having annual data instead of quarterly data. Okay? 6? Okay. Wow.
Sorry, 16.
Oh, 16. Okay. All right, very good. Very good. Okay, and let me come back to the, I'll describe these data items when we come to the tables. So these are the countries that are represented in our sample. We have a slight lean towards developed countries, although we have a few that are relatively, I guess, emerging markets, I would say. We have to be careful because some of these countries are financial hubs through which FDI flows kind of flow to and get dispersed, like the UK, Luxembourg, and the Netherlands. So we'll take them out in some of the regressions. Just some summary statistics here. These are the summary statistics on the elections. Again, this is from the World Bank database of political institutions, and the University of Maryland has this polity database, which is very detailed and nice. So in our sample, the average frequency of elections is once every 16.4 quarters. So very similar to the election cycle in the United States. The average length of term for the national leader, again, these are elections where the national leader is determined. I guess that's important to mention. In our sample, about 74% are legislative, parliamentary type elections. The rest are presidential. Just under half of them are characterized by having fixed timing, which is good. We get a lot of turnover in our sample, so 56.4% of the time there's a change in the national leader in our election, and just under half of that represents a change in the governing party. And these are summary statistics for some of the control variables and the conditioning variables that we're going to use. The checks and balances, so this average of 4, so what it does is each year they count the total number of veto players in the government. So for a presidential system, think about the US, for example, it's going to count up the number of chambers of government that have veto power. So you'd have Senate and House of Representatives, you'd have the executive branch, and you'd have the judicial branch. And then it's adjusted. So the US doesn't bounce around as much as parliamentary systems, but it's adjusted by party affiliation of Congress versus the president. So if the president has the same party as both the Senate and the House of Representatives, it's reduced by a factor of 1. If they have opposite, if they belong to different parties, it's increased by a factor of 1. With parliamentary systems, the way that they do it typically is they'll increase the number of veto players by 1 for every different party that belongs to the winning coalition. The idea is the more parties you have, the more hurdles you have to go through to change policy. And then we just borrow the typical empirical specification from the FDI literature, which is just going to have some control variables that I'll describe later. And then we're going to construct just some simple dummy variables corresponding to the timing of national elections. And the one we're going to be interested in is just the quarter right before the election. OK, so this is the baseline result. Now, each column just corresponds to a different way of measuring the left-hand side of the regression. So there's no real general agreement on how to scale FDI flows. The one we prefer is looking at FDI rates. So this is the FDI flow in one quarter divided by the stock of FDI in that country in the last quarter. Some people like to use the FDI to total FDI. So you sum up all the FDI flows around the world and take the FDI flow in that particular quarter to that particular country as the numerator, FDI to GDP, and then there's this weird sign-preserving log transform, because these are net FDI flows. So in some cases, they can be negative when the money is repatriated back to the United States. And so the results, as you can see, and this is very typical of FDI regressions. Not many things matter too much. But what we do see is a pretty significant drop in FDI flows in the period just before the election. So this coefficient here, 0.0082, would represent, I think this is the 14% drop compared to the average FDI rate in non-election quarters.
Now, so it's country by quarter, and there's about 50 countries, and the data's from 1970 till now.
That's right. That's right. Now, one thing that we were expecting to see a bit more.
Sorry, you cluster standard errors by countries.
In this case, we're at the country level. Yeah, that's right. So in our other paper, when we looked at domestic investment, we saw a very interesting pattern where investment dropped and then popped up significantly after the election uncertainty or election was actually resolved. Here we don't get any statistical significance in the opposite direction post-election. Everything's in the right direction, I would say. So if we did some kind of non-parametric test over all the empirical results in our paper, there might be something. But we don't see the same exact pattern we saw with the domestic investment. Here we include US elections. This is one we're actually working on now because, as I mentioned before, since all these flows are coming out of the United States, these dummies are really just going to be average calendar time effects that correspond with the US election. So it's not as cleanly identified, I guess, is what we're getting when we look at the foreign investment. We've repeated this with the United Nations data, and we get roughly the same signs we get the same signs, but lower magnitudes. So that's something we're going to pursue.
Drop the US out of this. For the US, those two sets are collinear, right? US election and election.
Yeah.
And you drop the US out of this regression.
Well, what we did is just estimated the calendar time effects independently and then averaged them for the US.
So this is just, I mean, this is very clever. This just says, in Italy, for example, it's not just Italy having an election, but it's the US having an election.
That's right.
Because of the source of so much FDI that it's probably generating uncertainty in the outbound country.
Exactly, exactly. Okay, so it looks like both domestic and foreign sources of uncertainty matter. And this is kind of interesting given the current debate about whether uncertainty in the European market is leaking into the United States. There's also a lot of uncertainty coming from China. That's, of course, different. Everyone knew who the leader was going to be, but there's a lot of uncertainty as to what kind of philosophy he has or what kind of economic policy he's going to follow. Here we just repeat the same regression that I just showed you using the sample elections that are fixed in time by law. We've taken out all the countries where they have the option to call the election early, and the magnitudes are very, very similar. Significant drops, of course, because we've reduced our sample by more than half, but at least the results is still there. Close elections, so there are various ways to do this, and this is, of course, one challenge with the international data is we don't have any good ex-ante measures of electoral uncertainty, so we just have to take the actual voting returns and differentiate based on that. So here we just define an election as being close if the margin of victory is within 5%. We could probably use a continuous one as well. And what we see is that apparently most of the action in our main regression is likely coming from the close elections. So it's a lot larger when the election is relatively close, as you might expect, if uncertainty is what was driving the results.
This is an additive dummy, is it? So close is you get the coefficient on both.
That's right. So you'd add them to get the total.
So it's more than twice, basically.
Yeah.
You still get something from non. Right, okay.
Sorry?
So
that's right.
The other explanation I had in mind, I guess, I worked in the Treasury for a year in the UK, and I saw this there, which is in the run-up to an election, a lot of policy stops because you don't want to do anything that spans two different governments. And a lot of FDI requires subsidies. I mean, the UK government gives heavy subsidies to large amounts, particularly big projects, which by value would register. You know, Japanese car plants would get $100 million subsidies, and all that stuff could be put on pause around an election.
Yeah.
Which might be part of the baseline. It wouldn't explain the difference between close and non-close.
Yeah.
I don't know if there's any way to strip out FDI that got any kind of government subsidy and see whether that's...
With this data, maybe not, but as Scott suggested, maybe if we pulled out the joint ventures.
All the regions, do you know whether it's going into... In the UK, it was always poor areas. It was either high-tech or poor, they want to subsidise it. And I don't think there's any way to categorise low-tech in a wealthy part of the country is not like to be.
Yeah, we can't, I guess we could with the additional data. The one thing we do, however, is we're going to split the sample by wealthy countries and lesser developed countries. And so our expectation was governments in emerging markets are going to be more unstable. But what we actually found is there's no difference in the election cycle for high income and low income countries. suggesting that it's not really just an emerging markets phenomenon. And to the extent that subsidies are focused on emerging markets, I guess we could address it to some extent.
I thought the more national, I would have thought the reverse, but yeah, are you going to run out of time?
Yeah, we thought the reverse as well. So,
Rich countries have more government, sorry, good.
Yeah, just two questions. So like,
Yeah.
in your right-hand side, a bit concerned about because of a lot of different countries we have a capital control policy. So often we have control, capital control, for example, China, Indians, easy to FDI inflows, very hard FDI outflows. But in the fund, we have, at IMF, we have a very nice data set about cross-country every year with your right-hand you can control. Second, I would feel concerned with tax differentials. Because a lot of FDI, multinational firm, different tax differential cross countries. Maybe in your right hand side, you can use tax differential in your right hand side to control that.
yeah, so we do try to, we use some of the IMF measures of openness and terms of trade and stuff like that to capture those legal constraints on investment. And a lot of the liberalizations happen before the data starts. So we had put together a dummy variable, but then we realized it was one for all the countries in our sample based on the IMF measure. What was your second question?
Tax differential.
Yeah, tax differentials we don't account for. That's right.
And one suggestion from U.S. side. Basically, recently a lot of research about lobby, and I'm very interested about which country flow to U.S., which industry. We have a financial FDI and other FDI.
Yeah.
It's better you. It's a very nice recent paper by one of my colleagues. They check also senators donations from which countries. You can check which countries, which industry. Maybe you can control to U.S. Which type of FDI, which industry, which countries.
Yeah, that we can't do with the aggregated data. We would have to do with some kind of deal level data to distinguish by industry. So here we do a comparison with foreign portfolio investment, saying that the difference between the two is broadly the difference in the reversibility of that particular investment, but we can't do any cross-industry stuff.
Any information about banking flows? I see you have portfolio equity, portfolio debt, FDI. Do you have any information about banking flow?
We don't at the moment, but I suppose we probably could. Yeah. And we probably want to control for state-owned banks as well. There's this literature on the behavior of state-owned banks around elections too. Okay, so let me finish off about 3 minutes. Okay. So what kind of things counteract this effect of uncertainty? Well, we find that countries with more stable political systems, the effects are dampened a little bit. All right, we don't find consistent results across our specifications, but we see, for example, here that in general the average election effect is still there, and the interaction of the stability rating with the election dummy is positive, suggesting that the cycles are a bit more dampened. We find the same result when we measure the degree of checks and balances. So when the degree of checks and balances is really high and the policymaker is relatively constrained, the elections don't appear to matter as much for FDI flows. And here's the result I mentioned earlier. Somehow we don't find a difference between high-income and low-income countries in the election effect. And here, basically, just to finish up on, we then take a look at the foreign portfolio flows. All right, we construct the same empirical test, and what we find is no real significant change in the patterns of foreign portfolio flows. Now, of course, statistically, we just fail to reject, right? And we haven't done any formal tests of the coefficient on the FDI versus FPI yet, but that's something that we're going to do, which will be very easy, actually.
Sign goes in the other direction.
Which one?
For your flows. So does it suggest a positive or a negative?
Here it's really nothing going on. I mean, 3 of the coefficients are positive,
There
but
could
we.
be some relation via exchange rates. So portfolio flows go in the opposite direction. It makes probably FDIs at that point in time even more interesting.
We control for changes in the exchange rates in both specifications.
You're thinking substitution as well, is it? I guess that you take a minority rather than a controlling stake if you don't want to take a controlling stake.
Could be. And unfortunately, we can't observe the size either way. It'd be nice to actually do a test around the threshold of 10, but in reality, it's really spread out around that 10% threshold, like 80% to tiny, tiny positions in these companies. So just to conclude, we view these results all taken together as being supportive of the view of a causal relationship between policy uncertainty and FDI flows, subject to those disclaimers that we talked about earlier on. So the strength of the argument, I think, comes from the fact that you can probably come up with another explanation. It hasn't been modeled yet, but it would probably have to be somewhat convoluted, but could possibly happen. We'll see. Any other questions in my last 0 seconds? Okay. Thank you.